If you haven't heard the news yet, Brandon Turner announced on Instagram about 7 days ago that he lost $15 million of investors' funds through one of his syndicated properties. This video, we're going to break down kind of what happened and our opinion on if this could have been avoidable or not.
Yeah. Do you want to go through what he actually posted?
Yeah, so it's on his Instagram post. It's a long carousel, but I'll just read the first part because like he starts by saying, "This sucks." And yeah, this sucks to even talk about. Like, as fellow real estate investors, you never want to hear this happen, but it does sometimes. So let's just get right into it. So Brandon writes, "This sucks. I just sold a huge apartment community and more than 15 million of investor capital was lost, totally wiping out some of their investors' money. To my investors, I'm sorry. And this is on a deal where rents were 30% higher than when we bought the property and we sold it at 95% plus occupancy. So how does this happen?" And then he breaks down the whole story and all the details.
Yeah, and we'll go through some of those details as we go. But I guess we could back up for those who may not be familiar with what a syndication is. So a syndication, in its simplest terms, is a way to crowdfund or bring in multiple investors. So you have a general partner who is pulling the deal together, pulling the debt together, finding the property, underwriting the property, all kind of the logistical parts of real estate investing. And then you have limited partners who are essentially the money. And those people get a certain percentage ownership in that property. And yeah, so someone's bringing the money and someone's bringing the deal. And you put that together, you have a syndication. Most syndications do typically typically for accredited investors. But there are some syndications out there that you don't have to be an accredited investor, which means you can invest much less money to get into. Either way, it's a different form of investing in real estate. It allows you to get into those much bigger properties. You're talking hundreds of doors at once. You can scale a lot faster with a syndication. But it comes with its own risks, of course, just like any other investment, as we're learning here through Brandon Turner. Yeah. I don't know. My opinion from this is you only lose money when you're forced to sell. If you're able to bear any market, regardless, and we'll get into the details of what actually he says happened, but like regardless of what happened, whether it's the market, the rates, the tenants, the underwriting the deal, the landlord, whatever, it doesn't really matter. Ultimately, you only lock in that loss, in my opinion, once you're forced to sell. And that's what happened here. He could have, if he was in a position where he could have held the property until it was a quote unquote a better time to sell, maybe he could have at least gotten out without losing money. Still may not have been a great return, but I don't know, that's my opinion.
And he tried to do that too. He did a capital call, which is when you have to do the really sucky thing and go back to your investors and ask for more money, and it ended up just, they still fell short, but we can get into that.
Yeah, exactly. So, I mean, the reason he was forced to sell, it comes down to the loan he had. So in a lot of commercial loans, they are ARM, adjustable rate mortgages. So what that means is you may, again, it depends on the specific mortgage, but a pretty standard one would be maybe a 5-year loan or 5 years fixed. And then after that 5 years, the rate starts adjusting. And that means you may have had a great rate in the beginning for the past 5 years, but now that you hit that 5-year mark, it's going to start adjusting. Could go 7, 8, 9, 10, depending on where rates go, right? So it could go through the roof. And if you underwrote that deal using a much lower rate, then that deal may fall apart once you start getting into that adjustable timeline. These commercial loans can work in various different ways. You can call banks and lenders and they'll have different products, but that's kind of a generic type of loan that may be out there. Of course, the alternative to that is a fixed rate loan. In commercial, that's a little bit more difficult to get. They usually want to be, a lot of the lenders want to be on an adjustable rate, which does put a lot more responsibility on the syndicator or the investor to make sure they're following that market, and hopefully not waiting until that 5-year mark, if that's the term, to refinance, because that's kind of putting yourself up against a wall. In our case, we pretty much only work with fixed rate mortgages. Again, people may say that you can't get that on commercial. What we found is if you call enough places, you will find fixed rate mortgages on pretty much anything. Now, you may pay a premium for that. You may not, they'll want you to go for the adjustable rate mortgage and may give you a better rate on the adjustable rate mortgage, but you're taking on a lot more risk with that adjustable rate, which is the risk that Brandon Turner now is living through and his investors. So yeah, that's kind of what happened is he ended up against a wall. He went through on the carousel posts and listed off a handful of things between
insurance, property taxes, capital expenses, repairs and maintenance. We're all living in this economy together. Right. Everything has increased since he had initially underwritten the deal.
But ultimately, it all matters. But again, if he was in a position where he could hold the property and the rates didn't go up, like clearly it worked at one point. It doesn't really matter what the property is worth, because the property only matters what the property is worth once you go to sell or refinance. He was going to go refinance. I think he tried to refinance, and the rates were just too high. He couldn't. He was forced out of that loan. And
that was despite increasing the net operating income by like $1.5 million or something.
Right.
Just to show you how much of the underwriting kind of failed there.
Yeah, which I think on one hand, I say it was a failure because he was forced to sell. But on the other hand, I'm like, is it forced to sell, or did he just poorly underwrite this deal and to begin with? Like, to not consider increases in the rates, to not consider insurance, taxes, all those things going up. It sounds like maybe, and I like Brandon Turner, it's nothing against him, but this is just a reality of underwriting deals. Like, you may force the deal to work in the beginning. You may look at it through rose-colored glasses and think, I can make this deal work. The chances of this happening, of all this perfect storm of taxes, insurance, rates, all that happening, it is so unlikely, but here we are, right? Yeah. And honestly, rates aren't even that high. I know it feels higher than it's been, but we're not in a double-digit territory. Insurance has definitely gone up, but that's to be expected. Repairs and CapEx that he mentioned, he should have known about all that when he was underwriting this deal, when he was doing his due diligence. That shouldn't have been a surprise to him. So to me, it's a mix of underwriting the deal poorly, as well as being putting himself in a position to be forced to sell. I'm curious, comment below if you guys think it's one or the other.
Or something completely different.
Or something different,
yeah. That we're missing here.
But, go ahead.
No, and I just think it's really awesome of Brandon, honestly, to share and be this transparent. We always kind of talk about we don't gatekeep. If people ask us about our numbers, we're always happy to talk about it and how we underwrote our deals the way we did and why we walked away from certain properties and why we decided to go all in on others. And I think whenever you're giving somebody your hard-earned money towards an investment, you really want to work with someone that's fully transparent. So no shade to Brandon at all. I actually can respect someone more that owns their mistakes.
Right.
And you could tell this is something that he's taking on the chin and he's learning from and will do better in the future. And I think that's especially someone that's probably the number one real estate investor influencer out there, to really take ownership of that is really cool.
Right. And I think it's a good lesson learned for any potential limited partners. If you're going to be investing with a syndicator, be cautious, right? Even some of the best out there fall, right? And it's important for you to understand the fundamentals, you to underwrite this deal, or at least follow their own math and maybe call out this looks a little optimistic. And you may want to look up against a few other syndicators that may have, I don't want to say slightly better track records. Probably do, but also maybe view it a little bit more conservatively. Now, with viewing things a little more conservatively, of course, that comes maybe with a lower return. but it's your risk reward, right? I know one
Right.
syndicator I really like, Ken McElroy. I follow him a lot, and I recommend looking at his YouTube channel and his content. He talks a lot about not going in on super high leverage properties, right? Like he may only be at 50 or 60% LTV and not be fully leveraging the property for the sake of all of these things. He underwrites these deals typically where the numbers still work, where there may only be 70% occupancy. So it just goes to show like how risky do you want to go? And now Ken is one of the biggest syndicators out there. He's operating some of the biggest portfolios, and he's doing it very successfully. He may have had failures in the past.
I'm sure he has.
Yeah, I'm sure you got to learn from your lesson, and maybe he's doing that because he's had failures. I don't know, but it's just interesting to see. Like Julia was saying, one of the biggest, most well-known investors out there falling a little bit and stumbling, and I think it's a good gut check for us all to make sure we're not always viewing things through rose-colored glasses and really being critical of ourselves as we're underwriting some of these deals and being realistic as much as we may want a deal. It's like
don't force it to work.
Yeah, don't force a deal to work. There's always a better deal around the corner.
Yeah, and speaking of Ken and what this really means for you at home, Ken's been talking about this forever, that this has been coming for syndicators with these adjustable rates. They locked them in a few years ago, and they're coming due. And Brandon's not the only one. That's the thing. Like he's the only one that said it out loud, but don't be fooled. Like it's happening to a lot of people.
This is a wave that is already here and still to come. There's a lot of syndicators who back in 2021, 2022 got these adjustable rate mortgages. Most of them have a 5-year balloon, they call it, or balloon would be when it's due, or the adjustable rate comes in that 5 years. And if you look at it, we're at that 5-year mark. And these syndicators are really struggling. He's like Julia said, he's not the only one. He may be the only one talking about it out loud, but he is certainly not the only one. So super important to kind of have some dry powder, some cash on the side, that you may be able to take advantage of one of these deals. You may be able to scoop up a relatively large property that was a syndication and get it for pennies on the dollar, because they don't have a choice. It's either they're going to get foreclosed on, or at least they can recoup a little bit of their investors' money. It's better to recoup some than none and just get foreclosed on by the bank. So you may be able to get some of the deals of a lifetime in the situation if you're ready for it.
Yeah, so definitely be on the lookout, because this isn't the first one. Yeah. There's going to be many more, unfortunately.
Yeah, and then lastly, I just want to talk about why we don't do syndications, and this is part of the reason, right? Like when you're taking other investors' money, that's a huge responsibility. You really have to know what you're doing, and I feel like we know what we're doing, but we prefer to be only using our own money. We prefer to be 100% owners. We can make the decisions ourselves. We prefer to take on the risk fully ourselves, so the upside and the downside is all our own. And maybe naturally that makes us underwrite deals a little more conservatively. I think it's easy when you're using not your own money to say, let's just try it and see what happens. Not saying that's what happened here, but just I know that's how probably I would feel if I was using other people's money. So we tend to, and you
scale slower. Like that's another thing too. I mean, in our 5 years of real estate, we have 5 homes.
Right.
And our growth isn't as sexy as, we just acquired 100 new doors or 400 doors through the syndication, but it comes at the price of, not being in these vulnerable situations and having the responsibility of other people's money.
And it's 10 units that are fully ours. We're getting all the cash flow ourselves. We're not having to split it with investors, which is nice. And I guess I said it before, but the being cautious of other other syndicators out there, the influencer market is they're littered with syndicators and people who honestly are probably 18 years old that have never owned their own property and are suddenly a syndicator of a 100-unit building. And to me, it's nuts. I mean, again, look at this situation of someone who has so much experience still struggling. And it's a tough business. It's a risky business. It's a tough one.
Just be cautious where you're putting your money. That's all. Because
exactly.
even the best of the best still make mistakes, and you need to be aware of that.
Right. So anyways, like I said, curious what your thoughts are. Comment below if you think it's due to being forced to sell or being just underwriting the property poorly. Curious what your thoughts are, or something completely different. Any closing thoughts?
That's it for me, but thanks so much for watching. Definitely hit subscribe and let us know what you think of this video and what you want to see next too.